are the financing options for entrepreneurs in general? So, first of all, as a startup CFO, you know that you have to pay close attention on your cash flow. When you know what your cash flows are in the future, you also have basically determined your financing need, and now you have to look for the options where you get the money from. And first of all, I'd like to start with a very general picture on financing, which is choosing between debt and equity. So what is the difference between debt and equity? Actually, debt, that corner, is capital which is given to you, still belongs to other people, and you have to give it back plus interest rate. You can have short-term debt, short-term credits, which is, for example, the credit line on your bank account. And you can also try to obtain long-term credits. You go to a bank or a mortgage for your home is a typical debt financing long-term credit. The other way of financing your venture is by equity capital. Equity capital means this is capital that belongs to the company and doesn't belong to the investor anymore. And the investor in return gets shares from the company. So if you buy a share from Apple nowadays, you can buy it on a stock exchange, you own a small part of the Apple Corporation. In early stages, those companies are not listed publicly. You have a private contract of, I do buy a share from this or that company. And this is equity financing. So equity financing is basically being done by equity capitalists, and they do it because they want to put in some money by law and sell high later on when the value of these companies have increased. And I started below in this chart because what you can do is you can obtain equity and debt capital from external or internal sources. Normally, we do think about external sources. A bank that is giving us debt capital, or a business angel, for example, giving us equity capital. That actually, as an entrepreneur, don't forget internal financing. Most of the internal financing instruments don't work for entrepreneurs, but one might work, and don't forget it, because it's the best money you can have, the customer money, self-financing. If you can sell something to the customer and make money by that, that's the best money. Why is that the best money? Because you never have to repay that and give an interest rate, so it's not like debt financing, and you don't have to give away shares. So remember SAP. If the SAP people had the chance to sell the founders sell themselves as software consultants, they were making money, they were actually self-financing their business, some kind of internal financing. However, if you look at very successful companies that have been financed in various ways, also really old companies, Ford Corporation was financed with external equity. Actually, when Henry Ford started his company, I think 1903, he had 12 investors from Chicago who were giving him business angel money, equity capital, got a share from the Ford Corporation that he was able to build his first cars. On the other hand, Dr. Oetker, a German company, actually started producing baking powder. Now is in a company in the food sector. They were financed without external equity. So basically, they self-financed them. August Oetker, the founder, he bought a drugstore and improved baking powder, and this baking powder was his first product, which he sold large scale. However, he always financed his growth by himself, no equity financing. So there's still family-owned companies who never obtained external equity, who hold the entire equity by themselves. And that has implications I'd like to comment on in a minute. First of all, if you look into the two possibilities, debt versus equity, in most cases, and it started with the Ford Corporation, but also all the other examples of large tech companies had to be financed by equity capital because debt is just not the right way to finance that. So this is why I focus on equity financing first, because equity has a chance to also realize large amounts of money which can cover losses on other investments. And if you look at equity capitalist in the regular portfolio, you can basically see that in a typical venture capital portfolio, one company is responsible for 80-90% of the return of the entire fund. And five companies are bankrupt, and three companies might be living death, so they never make money for the capitalist, and only two count for the real returns. Meaning, if you do equity financing, you get a share, and you have one companies where your shares have a high value, that this high value can cover for the losses of all the others. And this is why we focus on equity financing, because this is the regular case for tech-driven companies. And equity financing can be, first of all, in the first instance, if you differentiate it firstly into private equity and public equity. So when I started talking about Apple nowadays or Google nowadays, you can buy a share from Apple or Google because it's publicly traded on a stock exchange. So if a company goes public, initially offers shares to the public, which is an IPO, they bring the shares on the market. Everyone can buy those shares of stocks. This is the public equity market, and it's an important market for larger companies, and you as an entrepreneur might go into that when you bring your company public. However, it might take some time. On the other hand, and more important for entrepreneurs, is private equity. So private companies or individuals give money to companies on a private basis, so they have an individual contract between the capitalist and the entrepreneur. By the way, remember the principal-agent relationship. Now there is the principal-agent relationship again. The equity capitalist gives money to the entrepreneur. And you can differentiate that even more into early private equity, which is the focus of the startup CFOs, because as startup CFO, you start working early in your company. You get the first money maybe from family and friends, and then from angels, and then venture capitalists. This is all early stage private equity. And then there is a market for later stage private equity. And this later stage private equities are the typical buyout structures, where you also can find large funds who do buyout structure, and companies who are held by private companies in a buyout setting. So this is the first differentiation. And if you want to go deeper, and I'd like to focus now on the early private equity part, you can even differentiate that more and say, okay, there's an informal part in the early phase equity financing, and there is a formal part. Informal means there are private individuals who normally don't have a fund structure. And this starts with family and friends. This is in most cases, it's actually your own money as an entrepreneur. This is also why you sometimes call it the 3 Fs, founders, family, and friends. And if you need more, you go over and try to find business angels. But this is still called the informal equity capital, because it is private people who invest in companies. And by the way, it has consequences, this difference between informal and formal, and this is an important thing to understand in playing that startup CFO role. The other side is formal equity, and formal equity is basically a fund structure, and that could be a financial fund structure or a financial plus strategic. So a pure VC or a strategic investor having that formal equity fund. So the typical VC is Kleiner Perkins in the US, and the typical strategic investor are all the big corporates who actually have corporate venture capital activities. The main thing, why is it called formal, is that it is a fund investing into startups and investors investing into that fund, and that also has consequences on the relationship between the investors and the entrepreneurs. So if you look at on the typical entrepreneurial journey, and you can see that there might be also some kind of divergence of interest. And taking that example of Facebook again, Mark Zuckerberg once said, as a founder, I want to have control over my company. I can totally understand that. However, an earlier employee also said, I pass on high wages. Wages are not so important for me, but I'd like to participate in the value we create. That's very entrepreneurial, but if he creates a lot of value, he can participate in a much better way than with just wages, depending actually also on the employee and also his perception of risks. And Peter Thiel, one of the first investors, said, as an investor, I want to participate in profits and have control over my investments. So control is most important for Mark Zuckerberg. Profits and control is important for Peter Thiel. And Andy McCollum is somewhere in between. What is that about? This is actually a very important point for a startup CFO, for entrepreneurial finance in general, because this is the question between ownership and control. The question of power distribution, which is associated to equity capital. If you give away equity, you have to give away control. So ownership is always associated with control. However, there's no equilibrium like the risk return. There's a separation between ownership and control. You can have low ownership, high control, and vice versa. What does it mean? It depends not only on the number of shares you get, it depends on the private individual contract you make between the capitalist and your company. And if you allow the capitalist to rule your company because he has so many information and control rights, then he has higher control than he has ownership. Vice versa, look at Facebook nowadays. Mark Zuckerberg has shares somewhere in the 20s, but has control rights for more than 50%. So this is something you have to design. And you have to design that according to the objectives of the investor. Investor has wealth maximization as an objective. Actually, I don't want to run a company. I just want the company being run successfully, that I can make my money. On the other hand, the entrepreneur, he wants to remain in control and also increase his wealth. So he has different goals. Remember the divergence of interest? Here is a divergence of interest. Different goals, different objectives. And you have to balance that. And balancing that means you have to design the investor-startup relationship. And it's the startup CFO who has to design that within that dilemma. Because it doesn't go along. There's an ownership versus control, and there's different objectives. And as an entrepreneur, you always have to think about how much control do I have to give us for the capital I'd like to get. And this is to some extent a dilemma for an entrepreneur, which is most easily described by Rich and King. Few entrepreneurs really have both. So what means Rich and King? The trade-off the entrepreneurs have to make in general. Financial gains versus level of entrepreneurs' control. And also from my experience, but the experience of many entrepreneurs and capitalists, you can realize financial gains close to potential or higher than your potential or well below potential. you can remain in control a little or very much. And in most cases, what happens normally is founders motivated by control make decisions that enable them to lead the business, but they don't increase the value too much. So if you as a founder want to remain in control, you want to remain king, complete control, you normally are below potential because you don't raise enough capital in order to use the growth you can realize. On the other hand, those founders who realize the potential of the businesses, they can be very rich, but at the very end, they remain with little control, which is not necessarily a bad thing, because if you end up rich, it might be the thing you wanted. Founders sometimes don't want to end up rich, they want to end up king. And it's difficult to combine both. I mean, a failure is if you have little control and you're below potential. But the exception, and the big exception, is you realize your potential and you remain in control. Mark Zuckerberg is surely a great exception for exactly that quarter here. So most founders pay too much attention on remaining in control versus getting rich. Some founders understand that. However, I'm not saying you should be rich or king. You can try to combine both, but that's most difficult. And this is what a startup CFO really has to work on, balance on. And this is, remember, being done by the financing rounds, by understanding your business, by developing your business stepwise. Because if you have a startup idea, you can develop your corporate strategy in different ways. Developing your corporate strategy in different ways also means you decide on the control you have. If you don't need equity capital, SAP example, you might be slower, but you remain in control. Remember our competitor. If you need more capital, you can do that, but you have to give away at least some control, and maybe you even have to give away more ownership. So that's what the financing strategy is about. And even if you have total capital requirements, you might want to look into the financing requirements per financing rounds, at least in order not to give too much control away. If you split it in financing rounds according to the value increase of your company. So ideas can be carried out in totally different ways. Less available capital implies slower business development. However, it also implies you don't have to give away so much control, and finance requirements might change in further rounds, and then you have to look for the potential sources you have. Well, that's a crucial part for the startup CFO, understanding the relationship or the separation of ownership and control, and understanding that in the setting of entrepreneurial finance, since ownership of an investor does not necessarily mean the same control. It can differ, and you have to design that. And designing that is strategy financing rounds, plus in each financing round, the relationship and the contract.